past experience. So you record uncollectible accounts expense and you transfer it to income statement. Because when you plan cash budgets, from cash budgets, you directly can develop budgeted or budgets for income statement, budgeted balance sheet, budgeted income statement, right? So in that sense, whatever you budget or plan, that will go to income statement so that the profit figure remains constant and according to the plan, right? So whatever you plan for, uncollectible is your expense. You transfer it to immediately in your planning, you transfer it to income statement so that your profit is already reduced and according to the plan. So everyone, you understand that? Let me ask Anis, Nimesh, Dijodi, Kathleen, you understand what's going on here?
So you're saying you're saying if we have uncollectibles, we immediately add them to the income statement, even if we don't record uncollectibles?
Yes, because right now we didn't sell because we are making plans for next year, right? So sale is not yet happened. We didn't book our material. We didn't sell. We didn't, establish the business operation. We are planning right now. So we, before getting into sales and all those stuff, so we basically established this allowance for uncollectible. So that when actual sales started, booking of the material started, payment started, so we stick to our plan. Right, Florian, you understand? Fabian, Ali, Wuxiong, Lota?
Yes, understood.
Good. Now we move to the next step. How we establish or set up our allowance for uncollectible. So remember, this allowance for uncollectible is contra account or opposite account for account receivable. Like we talk about, we establish contra account for plant assets like recording depreciation, right? And we talked about over there. We will talk about when we talk about account for plant, property and equipment, fixed assets. But remember that one, this setting up of the allowance for uncollectible accounts, we set it up against account receivable. So it means increase in account receivable means debit. So increase in allowance for account uncollectible account would be credit, opposite account, right? So amount for receivable, business expects that is not to be collected. So it is basically the amount, for example, 2% of sale, 3% of sale, whatsoever. So that is because of business expect it won't be collected if we sell on credit. We set up allowance for uncollectible accounts, and the nature of this account is contra account, opposite account for account receivable. So it means it goes in opposite direction. So if account receivable is increasing, account receivable increase means debit. So allowance is increasing, it means credit. Right, guys? So here we go. So how we are going to record this on balance sheet? So you see, we have account receivable, and we, according to our plan, we would be selling on credit 500 million, right? And through our analysis, we find out that allowance or $25 million worth of amount is not going to be received. So if we immediately decrease it, and on balance sheet, you see, you have a word 475. So that our planning is not disturbed. Our planning is at the end of 2022, we would be, or closing of 2021, our total asset would be 1,657, right? And then you manage accordingly, and then you start the year of 2021 with this kind of amount. So in your plan, you would be selling worth of 500,000, 500 million worth of goods to its customers, and you receive 500 million. You have to receive $500 million from customers, but you said 25 million is not going to be received. So in advance, you create an contra account and you say that, okay, for sure, according to your plan, this much would be received. So now build some scenarios. It can, in actual sense, when you start and, in actual, the uncollectible can be more than 25 million, can be less than 25 million. So what happened if instead of 25 million, 35 million is not received? It means your planning is bad. You are a bad manager. You didn't plan effectively, right? Or maybe your collection policy is so bad. Maybe
in this kind of case, can you adjust by taking the amount of the money from the return earning, which is the revenue? Can we?
yes, but return revenue is something else. So it is called, sales return. So those customers who don't like your goods, they return you back. So in this
No,
case,
return.
retain earnings.
Yeah,
No,
this
retain
one.
earnings had nothing to do with this, Florian. This is not earning. This is sales, right?
There is something that either we choose to give it to the owner equity or we keep it for the next year. How do you call this? Is return something?
Retained earnings.
Ah, yeah.
It has nothing to do with retained earnings. So we are managing our clients. We are managing our account receivable. So right now we are talking about asset side of the balance sheet. We already talked about cash. We are now talking about accounts receivable. In next lecture, we will be talking about inventory, right? So it has nothing to do with retained earnings. So my question is, if you book your, in advance, you plan that $25 million is not going to be received from customers. What if in reality, at the end of the year, it happens to be $35 million? It means your planning is bad. So what are the reasons? Maybe the collection policy is not good. Maybe you give more credits to less worthy customers, those who don't have, or those who are those who are C plus customers. You gave them more, goods according to their credit, you know, ratings. Or what if it's $10 million? What does it mean? It means your customers are ethical, right? Your collection policy is good. You timely remind them, okay, 10 days left. You need to send your goods or send your money in this, 10 days. You remind them collection policies, right? You call them. It's like that. So in order to receive your money on time. So which one is good policy? $10 million or $35 million? Of course.
35.
No, sorry. 10 million.
But we want more money, right?
This is loss.
Ah, okay. Yeah. 10
Allowance uncollectible. You plan that next year is going to be $25 million that is not going to be collected. But instead, your plan go wrong and you are not able to collect $35 million instead of 25. So it means your management is not good, your planning is not good, or your collection policy is not good. What if at the end of the year, your uncollectible is $10 million instead of $25 million? It means you did a great job,
Yes.
right?
It's
It's
better.
like
It's less loss. Less
less,
loss.
less loss. Good. So it means you increase your profit $5 million more through your collection efforts. That's good. So there are two methods to write it down. Number one, let me clear this mess. You write down like this: account receivable less account allowance for uncollectible, or you can write it down: Account receivable net of 25 allowance, 475. So there are different methods to present this information to your balance sheet, right? But this main figure remains the same. See? So this is just different, presentation. How you can express it. So net of 25 allowance means allowance for uncollectible is 25 million. So your sale is, you added 25 here, so you can find out your sale is 500, right? So you can just develop as well. Okay, now here comes. So the question is, you said $25 million would be allowance for uncollectible. How you came up with this 25 million? In this question, this 25 million as a allowance, how you came up with this? So there are two methods. Number one, percentage of sale method. Number two, aging of the receivable method. Both are legitimate and good methods, but each has, according to the size of the company and, whatsoever. So it has its own, merits. So easy method is percentage of sale method. So you see your sales on year basis from your past and you compare it to your sales, compare the uncollectible with your sales, and you realize that, okay, 1%, 2% or whatsoever, that would be your uncollectible. So here we go. So percentage of sale method is also called income statement approach because the figure of sales can be found on income statement. So we call this income statement approach. Aging of receivable can be found on balance sheet, so you can guess. Aging of receivable method is based on balance sheet approach. So when you are planning for uncollectible, if you are using percentage of sale method, then you need income statement. You see the past income statements, that's it. And if you are using the second method, aging of receivable, you don't need income statement, you go for balance sheet. And then you can find out the amount for uncollectible. So let's just talk about this. So what is percentage of sale method? Simple. You estimate, you multiply with the sale revenue. This is the uncollectible account expense. Simple. Let's just talk about this. So assume that it is September 29, 2012. And Apple Incorporation accounts has these balances before the year-end adjustments. Okay, before the year-end adjustment. It means we make the trial balance and now we are adjusting the entries. Like we talked about, okay, prepaid rent, prepaid, and outstanding expense, accrued expenses, just like that, and depreciation expenses. So on that part, you also go for uncollectible as well. So here we go. Suppose Apple credit department estimate that the uncollectible accounts are 1% or 0.0005 of the total revenue. Right? And your total revenue is 156,508 million. So 156,508 million multiplied by 1% is your uncollectible expense. Right? So how you create? So what are the figures? Simple. 78 million. You multiply 1% or 0.005 with your sales. Answer 70. So how you record it? This is a challenging one. How you record the uncollectible? So this is actual.
Not receivable.
This is actual uncollectible or this is expected?
Expected. So not receivable, right?
Yes, these are expected uncollectible. So you create reserve or allowance. How you make entry?
Is not receivable.
It is receivable. We